Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Last week, we were on break as I was up in Canada conducting some capital markets training classes to a large Wall Street firm up there. So this week, I want to get back into things and spend the bulk of our time together discussing what's going on in a couple of the key markets, as well as review some widely held names. So this is really going to be a half hour together going through just a bunch of charts. We're not going to do any type of educational component this week. I figured it's given what the market's done and kind of the pause that we had in the S&P up and around 2,800. Let's take a look at what's going on across a variety of markets. So we're going to start off by looking at the S&P itself and a couple other major asset class markets, and then we will get down to some widely held stocks that decent chances are that you've got a bunch of these in a diversified portfolio, so I thought it made sense to do that too. So here, let's start off. This is a daily chart of the S&P. A couple things to highlight here in general. Notice that back in very late September, just before we made all-time highs, a day or two before, we had an aggressive sequential 13 upside exhaustion signal, which you see me kind of circling here with my mouse. That indicated, for those of you who are tuning in for the first time, this model is an institutional model that very few people, let's say, in the public have, mostly due to cost. It was developed by a gentleman named Tom DeMark. You'll see him on CNBC and Bloomberg on occasion. He doesn't make too many media appearances. He is a consultant to some of the top hedge funds across the globe. And this is a model he developed back in the 1970s, looking for how to identify exhaustion of trends. And one of the things I can tell you, having been in this industry myself since the early 1980s, and then first coming across Tom and his models in 1995, is that this model very much blends well into my concept that I've really been able to delineate myself against, let's say, competitors and other people in the industry who look at charts, or at least look at the market from a non-fundamental point of view, is that this model helps define likely turning points to trends. And though it may be counterintuitive, and a lot of people in the marketplace will tell you that the most money is made playing the trend, the reality is that professionals on Wall Street, their goal is to get themselves positioned properly for the next trend of significance. And that ends up being more important and more of a money-making opportunity than it is simply playing the trend while the trend is obvious. And let's say you've got a good solid bull uptrend, the market's moving higher. Of course, they want to be long for that. But in general, they don't want to wait until the trend is so obvious to first get into that they've missed, let's say, anywhere from 10 to 20% of the move on the bottom before it's rallied enough. And they say, oh, it's an uptrend, let's get into this. And same thing on the top side. They want to be able to sell close to real highs so that a stock doesn't decline 15, 20%. And then in hindsight, they go, oh, look, that was the high a couple months ago. It's come off 20%. It just broke underneath some interim low. We probably should lighten up and get out. The bulk of the street, and when I say the street, this would also include individual investors, tend to play in the first standard deviation of all price activity, the middle 70%. They leave the tails on either side to traders and people who have more sophisticated models to be able to do that. And that's actually where I made my niche on Wall Street in my 30-plus year career there, by looking to identify trend exhaustion points and being able to identify likely turns such that an institutional client could be positioned properly for that turn before it's obvious. That's the type of thing that occurred back here in October. 4 days after the all-time high was made, we suggested to our institutional clients to hedge their portfolios against a further decline. And obviously that worked fairly well considering just how much the market fell into the December bottom. What we're seeing now is in the middle of February, we saw a 13 and a setup 9. A setup 9 is 9 consecutive price bars that the close is greater than the close from 4 bars earlier. When you get these close to each other, that's often a potential short-term turning point. We certainly saw a quick 1-week decline. The market has recovered, made new 2019 highs, but then again, last week, we get another sequential upside exhaustion signal, and of course, we had the big down move on Friday last week, and we've recovered a bunch of it. I'll tell you now, as far as how I'm looking at things, is we need to get above this line in here, which is just about 28.30. If we can't get through there, then that's going to be a pause point, and we could easily see the market decline again. So that's one thing I'm focusing on right now, is given this 13 count, and a chance for upside exhaustion for the near term, I actually have turned tactically neutral for the last week of the quarter, which ends this Friday. Typically, you'd see a fair amount of window dressing, and I have been bullish for most of this move off of the December bottom, and especially when you think about how many portfolio managers are trailing their benchmark and not up anything close to, let's say, what the S&P is for the quarter, because of the December down move and the change in psychology that they started 2019 with, and be much more defensively positioned. That's the type of thing that has given me reason to believe most portfolio managers are not up what the S&P is. And then as you get towards the end of the quarter, you tend to get some what's called window dressing, some buying of key names to at least show that, so a portfolio manager can show that they've got them on the books of the portfolio. And it's a little bit artificial in trying to, it's not to fool investors, but it's to say, here, at least we have these names, even if we didn't buy them well, we at least have them in. So you've got a little bit of a back and forth push and pull right now in the market, because you've got this end of quarter coming later this week where you kind of expect to bid to the market given how much it's moved up and how many PMs need to kind of chase after the benchmark. And on the flip side, I'm staring at this 13 that says to me this is very well likely a place the market could pause. So we've gone tactically neutral at least this week. We'll see what April looks like as flows start coming in on April. The other piece to the near-term equation, here's a weekly chart of the S&P. And again, for those of you who listen to our shows from, I think it was late January through all of February, we did 4 or 5 episodes really concentrating on this sequential model and how it works, what the implications are. And we know that 13s and or 9s are potential turning points. And when you see the numbers come on top of the price bars, that would be looking for upside exhaustion, as it did, for instance, going into the beginning of last year. So this signal here very nicely warned that a decline was imminent. We had a massive 2-week sell-off to start or end January, and kind of, at the beginning of 2018. There's a 9 count here that gave us a 2-week sell-off. And this one was just a week or two before what ended up being the top in October. The thing is, now we know there's a 13 count on the daily and there's a 9 count on the weekly. So I've got multiple time frames suggesting that we're also at a place the market can pause. So with the S&P here, let me tell you, it's approximately at 28.25 as we record this now, up about 26 points today. This is not a place that I am jumping on adding new long exposure, but being more content with writing what we already have long and what we've been buying for the last few months since we identified that low. Speaking of identifying that low, I want to show you how it is that I came up in December in early January as defining the low in the market. Not just that Christmas low was kind of a good short-term low, but by, I think it was January 10th, we were in print to our clients telling them, wait a minute, that is a good low, that is the low, and that there is no bear market. This is, and I've made it very clear, there was no bear market in the US in 2018. This is not a bear market bounce, and I do not foresee for the rest of 2019 a bear market in the US. This particular index here that we're looking at, and I'll zoom it in even a little more, this is the ACWI All World Index. It's an ETF, ACWX, and this tracks all the major markets in the world exclusive of the United States. So it's fair to say that in 2018, which is the span here, or I can even make it easier and kind of highlight it here. Let's see. So if we look at 2018, it's fair to say that the rest of the world was in a global bear market. We peaked right at the start of the year, and we spent the entire year trading down. So yes, the rest of the world did have a bear market last year. The US did not. And until the fourth quarter decline, there was no really significant sell-off in the US, but certainly the November and bigger December decline gave many people the thought that we were in a bear market. And we have vehemently argued that there was no bear market, and that whether it was the media, combined television and print, who say, oh, the S&P fell 20% from its highs, therefore that's a new bear market. The NASDAQ had fallen 23%, so that's a bear market. We don't think so at all. And I don't want you as listeners to get stuck into thinking that some arbitrary number of 20% from a high or low indicates a new bear or bull market, or that 10% is a correction. These terms came about somewhere in the 1980s from some paper one of the sell-side firms had written. It had never been used on the street before, that 10 and 20% represented corrections in bull or new bear markets. And I think people get so stuck on looking for that definition of, oh, we're in a bull or we're in a bear. The reality is, when I look at the markets in general, the S&P still held anything it needed to on a medium to longer term basis. It was a short-term sell-off. The December decline, if you look at what the market looks like now, is almost as if it never happened. And in fact, I wrote a piece to institutional clients, I think it was last week, that talked about that fact that the December decline was truly as if it never happened. It was kind of like a never mind moment. It was a blip in the market that got people leaning the wrong way for what the truer move is, which is that we had a very strong up move and have continued to move higher since Christmas time. So this was the monthly chart on the ACWI index, showing me a 9 and holding the trend line from the December, not the December, the 2009 low. Now this ETF has not been around more than 10 years, but critically, it did start trading just before the low came in 2009. So this is a very valid uptrend line. And you can see the nines, in this case, monthly nines, so if we look at this section over here, this is a period of 9 consecutive months that the closing price at the end of the month was above the closing price from 4 months prior. And we know when that pattern shows up, you often have a change. And for the next, let's say from the peak here at 9, it took almost 2 years to get back to that same price. So that was certainly a very good warning system. The 13 here suggesting upside exhaustion. The 9 count here at the beginning of 2016 suggesting downside exhaustion. The 9 count here suggesting upside exhaustion. It was definitely early by a few months. But then again, we do a 9 down, holding the trend line. And that combined with, let's switch this to a weekly chart. The same time the 9 count showed up on the monthly, the weekly chart of that same ACWI or World Index, exclusive of the US, shows up with a downside exhaustion signal here, right here, showing us downside exhaustion. So 2 different time frames, same model, different elements of the model show with downside exhaustion. And that's why by early January, we were able to say, that's not just a good trading low that we saw at Christmas time in global equity markets. That helped us think like that was the low. And as far as I'm concerned, that December Christmas bottom was the low. It concluded the bear markets in the rest of the world, and the U.S. V bottom showed me that the U.S. never went into a bear market. You don't go into a bear market for 2 or 3 days because you hit some artificial number of 20%. And you can see since then, even on the ACWI, we've done 9 consecutive weeks close above the close. That peaked out here. We're kind of sideways since, which is what the 9 count often can give you. The same way here, it suggested that the trend that was potentially developing is going to go sideways. It went sideways for 3 months before we broke down again in the ACWI. So that's my thoughts that way. Let's take a look at the 10-year yield chart because with the talk of the inverted yield curve, etc. Actually, let's start with the weekly. You've got a very amount of people bullish bonds right now. And it's actually for the Treasury note futures. I think we're about 80% bulls for the 30-year bond futures. I think it's 88% bulls. So you've got most people leaning that way. Our call was that if the cloud model broke beneath, in TNX terms, TNX, of course, is the index that tracks the U.S. 10-year Treasury. So the decimal's off by 1 place. So when you see a price of 24.25, which is where it's trading now, that's the equivalent of 2.425%. So we said if it broke under 2.488, which was where the lagging line in the cloud model broke underneath the bottom of its cloud, we would probably test 2.344. So this week's low is 2.377. We got 3 basis points away. Obviously, it's a very quick move down. We may not be done to the downside at all, but we are starting to see some people in the bond market turn into sellers as we not only get towards the support level of 2.34%, but also at the beginning of our year when we did our forecast for the rest of the year, we said that for the bulk of 2019, yields, 10-year yields would likely stay between 3% and 2.4%. And if you broke underneath 2.4, the amount of time underneath it would likely be minimal relative to the amount of time that you'll spend above it for the year. So this is also an area that I'm starting to look at as a potential place to start selling bonds, whereas everybody else is looking to be buying bonds. Yes, we bought bonds for a quick move down of about 12 basis points or so, 13 basis points as a target. But as we get closer to here, we'll have to see how the market reacts in and of that. Obviously, we've broken the major uptrend line from the double bottom that took place. I think it was 2012, got down to 1.39%. And in 2016, we got down to let's see, I think it was just a little lower, 1.39, very similar. So long-term double bottom, good move up. We slightly got above the highs of 3%. We went to 3.25% and have kind of collapsed since. So the bond market, not a piece of cake by any means, to have been trading for the bulk of this year. In fact, if we shift to the daily chart on bonds, here we go. So you look at 2019 starting in January, and you see just how choppy it's been until this move over the last week or so that have really brought yields down. So that's my take on the Treasury market. Let's take a look at the U.S. dollar index. So here, what we see, I've got a few things labeled. One is let's take this off for the time being, makes it a little easier to see. So going into, this is where my cursor is here. This is the beginning of 2017. Trump had won the election in 2016 in November. The most, what's the word I need? The consensus call across the street going into 2017 is that the dollar would rally because Trump was in office, and what he would do would be good for the dollar. The reality is that that was the worst call the street made collectively in 2017. The market peaked essentially on the first day of trading for the year. It did a very defined 5-wave move down. As we get our 5th wave, we also get a 13 signal to say exhaustion of downtrend. So now I've got a 5-wave move that, with a totally different model, is telling me exhaustion of downtrend. This is where we got our clients long. We wrote it to right in here. The 9 count got us out of this move. We went neutral to dollar. We've tactically played it since. Haven't put on any major big position since. And notice that this ultimately peaked on a 13 count. That's now a good 5 months old already. And the dollar has been completely sideways since. This green line here is the 200-week moving average. So we have a flat 200-week moving average. We've been spending the bulk of the time above it. But at least basis this chart, we see a very defined range for the dollar. I could see it potentially expand on the upside up to, well, just short of 99, best case scenario. Getting above there would probably open the door for a bigger upside move. On the downside, you can see we've been holding just beneath 9,500. The key level is if we break down to just under 94. Otherwise, this is all sideways stuff. And as much as people think this day by day is affecting precious metals or any other markets, it is much less so because the dollar really hasn't been a huge factor. Here's the dollar on a daily chart. Here's the 200-day moving average, which caught the recent low. But you can see, again, we're in this sideways range. Multiple 13 tops in November and December, leading to a 9 count on the downside, leading into a 9 count on the upside. So we still have an unfinished potential 13 here, but I am just completely neutral to dollar and not doing anything significant there. Let me see. So we covered bonds. We did the S&P and we did the dollar. So let's take a look at some widely held stocks. And what the heck, might as well start off with Apple. So Apple, of course, is one of the very widely held names, and it certainly had its troubles. Fourth quarter, notice that this ultimately peaked on a weekly 9 count. We sell off and do a weekly 9 count bottom. When this happened, these few weeks right in here coincided with the cloud's lagging line. Now this, for those of you who don't know the cloud model, this lagging line is simply current price, where we are right now, push back 26 bars in time. So if it's a weekly chart, it's 26 weeks of time pushback. If it's a daily chart, 26 days. It's simply whatever time frame chart you're looking at. This lagging line is current price pushback 26 time frames. The important thing here was that as we made the 9 bottom, the lagging line sold down. Again, it's just replicating price. So this close right in here, bar 9's close, was this close here. The next week we get a rally. That's this close here. We then come back, kind of test. We actually break to the lower low, but notice we closed right in here to end the year. That was this close right here, right against the bottom of the cloud. This is the lowest risk entry price you're ever going to have on a model. because if it had broken any more, you would have turned what had been a bull market into a bear market. And I can't think of a better time to be a buyer than, from a risk perspective, than we're just about to turn a bull market into a bear market. Because if it breaks, you know you don't want to be long. And if you're right, you have virtually very little downside risk relative to very significant upside potential. And that's what we saw here in Apple. So Apple was a clear buy in the models we use right here. We'll call it the mid to upper 140s. Since then, like the S&P, it has done a 9 count up. It is now backing up into its general cloud. That's this whole shaded zone. So we're starting to get into resistance. So anywhere from here up to, let's say, the Fibonacci retracement at about 198.5 should be some type of resistance. So for those of you who bought and don't necessarily think Apple's going back to its all-time highs, as it approaches the upper 190s, not probably a bad place to take some off the table. We've got a couple minutes left. Let's take a look at some other charts. I figured, how could we not look at Boeing, given the news that Boeing had? Let me get rid of this extraneous stuff here. So I've seen Boeing as being really an expanding type pattern. Call it almost the first half of a potential diamond pattern, right? We keep making higher highs, and you made lower lows. Now, do notice that the lower lows still held into cloud support, so nothing had broken on this as far as major support. We extend beyond the high of these prior highs on an earnings report, which both help create a 13 and 9 just a couple weeks apart from each other. Does this model know that Boeing's going to have problem with their engines? No. It just says from a timing point of view that this would be a very high-risk time to be a buyer. So while a lot of people on the street were saying Boeing has broken out to new highs, you want to own this name over $400, we were actually telling our clients that's not the case. It's a high-risk buy. And again, I take no credit to know that fundamental news would come out and alter the look of the Boeing chart. So I'm not a soothsayer and knew that was coming. It's simply this model suggests that it's high risk to be a buyer at that point. It's now come down and holding we only had one close beneath the baseline in the cloud chart. Again, in general, this cloud should provide support. And at least if you like Boeing, it's a better buy here, kind of near 360 at the top of the cloud, than it is or was on what was supposedly a breakout above 400. We have got time very quickly for one more chart. Let's take Home Depot, something we haven't looked at in a long time. Notice the sell-off that broke the cloud in December. The lagging line held right against the bottom of the cloud. Low risk buy, turned around. We've now done a 13.9. We pulled back from it. We're kind of mid. It's kind of a name that's held where it needed to, but I'm kind of neutral on the name. So I want to thank you for joining us this week. As always, the half hour seems to go by very quickly. If you need to reach me, it's Rick at In the Know Trader, and check out inthenowtrader.com for our individual investor report. Thanks very much. Have a good week.